We've all seen it. Your phone buzzes with a message from your bank. Account debited. You check your balance and your money has gone down. Then, a few days later, a refund arrives. The text says account credited, and the balance goes up. Naturally, you learn to associate those words with money leaving or arriving. In the world of business accounting, those definitions change depending on which seat you're sitting in. When you deposit money, the bank is holding it for you. From their perspective, your deposit is actually a liability, money they owe back to you. When you spend that money, the bank owes you less. To record that their debt to you has shrunk, the bank debits your account. That bank notification records an event on their internal ledger, a brief look at how they manage their own books. Setting aside that bank statement habit is the first step towards seeing how a business actually tracks the movement of value. Accountants have used this system for over 500 years. In a ledger, debit refers to the left column and credit to the right. This layout mirrors the laws of physics. Value cannot appear out of nowhere or vanish. It only moves. Accountants use double-entry bookkeeping to track both ends of that movement. Every transaction must be recorded in at least 2 places to stay balanced. If you buy a physical book for 500 rupees using cash, your cash asset goes down. At the same time, your books on the shelf asset goes up by 500. The scale returns to perfect equilibrium. For every transaction, you record where the value came from and where it went. This makes the left and right sides equal every single time. By ensuring every action has an equal and opposite reaction, a company can mathematically prove its financial events took place. To keep track of millions of individual movements, businesses sort everything into 5 core categories, or buckets. The first 2 buckets are assets, the things a company owns, and expenses, the things it spends money on. These live on the left side of the ledger. Because they live on the left, any new left side entry, a debit, increases them. The other 3 buckets are liabilities, which the company owes, equity, the owner's stake, and income, the money earned. These live on the right side. For these categories, a right side entry, a credit, adds to their total. You can see this in action with a loan. A loan is a liability on the right. When you pay it off, you record a debit on the left, which shrinks the balance of what you owe. These 5 buckets, combined with the left and right rule, provide the vocabulary needed to translate business operations into readable data. In a large corporation, thousands of these left and right transactions are firing simultaneously across the globe. They all converge into a single core. This centralized database is the general ledger. It holds every single dual-sided transaction the organization makes. The general ledger maintains the 5 buckets, serving as the master running total for the entire company. It also acts as a safety net. If the total of all left entries in the general ledger doesn't perfectly match the total of all right entries, the system-wide equilibrium is broken, signaling an error. This makes the general ledger the mathematically proven source of truth for a company's existence. Think back to that bank notification from the beginning of the story. You can now interpret that exact same text message using the rules of the ledger. That message describes a localized left side entry used to reduce the liability the bank carries on its own general ledger. Understanding how value moves across these columns provides a clear, consistent way to see the financial reality of any business in the world.